The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
Online lending firm Figure is bringing securitization, the decades-old Wall Street practice of repackaging home loans into bonds, to the blockchain. Recently, they announced a subsidiary received regulatory approval to become a FINRA-approved broker-dealer and an SEC-registered alternative trading system, which means Figure can begin tokenizing their marketplace of loans. Joining us now to discuss is Mike Cagney, CEO of Figure and co-founder of SoFi in San Francisco. Welcome, Mike.
Thanks for having me.
Mike, perhaps you can explain in simple, very simple terms what Figure does, how it seeks to change the whole business of home lending.
Sure. So we started Figure back in 2018 with the idea that we could apply blockchain to various parts of financial services and generate pretty significant value. So lending was the first vertical that we focused on. And the idea was we could take out up to 100 basis points of cost from point of loan origination through to financing, through to deal execution and securitization. And we ended up building a blockchain called Provenance, designed specifically for financial services to be able to provide scale and data control and so forth. Initially in what we would call a quasi-permission chain, and then ultimately, more recently, now a full public open source decentralized proof of stake blockchain. And we processed billions of dollars of transactions through Provenance and have demonstrated about 117 basis points of cost savings. But lending was really the starting point. And what we've done is we've been able to build Provenance into a whole set of use cases, such as banking and payments, cap table management and private company exchange, fund custody and administration. And so we're opening up and de-risking lots of blockchain use cases that are billions of dollars of market cap that we think ultimately manifest back to the blockchain. The SEC and FINRA announcement are important because it's something we've worked on for over a year to get that broker-dealer exemption to be able to operate and exchange for securities on blockchain. And so now we can take not only our whole loans and loan participation that we used to trade on Marketplace exclusively, but now the securities that are generated from those loans and marketplaces and trading those on blockchain. But where it really provides an interesting opportunity is if you think of our cap table management business, we have Figure, for example, that uses Provenance to custody its equity certificates. We can now very easily turn on secondary marketplaces for private companies like Figure, allowing investors to trade T-instant equity settlement through the ATS exemption that we have.
Mike, there is a line of thinking, though, that blockchain is a really bad way to do almost anything. With regard to securitization, critics say it unnecessarily adds another level of complexity and that traditional centralized systems are good enough. How would you address that criticism?
So I think blockchain is definitely overused in financial services. It's not the most flexible and scalable technology in lots of circumstances, but where it becomes really valuable is circumstances where you can replace trust with truth and circumstances that benefit from real-time bilateral transaction settlement. And securitization is one such example. As I said, we've demonstrated 117 basis points of cost savings using blockchain from point of loan origination through to securitization, through to deal execution. So, and we've audited this. We've done it on hundreds of millions of dollars of securitization transactions. So I think we've kind of put to rest the idea that it's not an effective technology for securitization. In fact, it's incredibly effective, and that's a $6 trillion market. It's also incredibly effective for banking and payments using stablecoin payment rails versus Visa, MasterCard interchange. It's incredibly effective for creating bilateral exchanges that avoid the problems that we had with GameStop and the centralization that DTCC plays in the U.S. equity market. So it's an enormous technology that we think has huge application and huge upside.
So the SEC kind of casts a frightening shadow over the crypto industry. It's seen as very tough and also as having a lack of clarity. How hard was it to get through the SEC process and to actually get approval?
So it was a challenging process, and we spent over a year working on it. And one of the key points was that the SEC didn't want an SEC registered entity to take custody or control of a digital asset on blockchain. And one of the things, so if you're a centralized exchange, that introduces a ton of challenges, right? Because by definition, as a centralized exchange, you're taking intermediation and control. Our exchanges are completely decentralized, so they're truly bilateral. Counterparties face off directly against each other. They use stablecoin wallet to transact real time for assets, and so ultimately we were able to drive comfort for that fact. And so what we're able to do are operate these decentralized exchanges for securities now, which again opens up a huge opportunity. It's way beyond loan securitization. It's any security we can now represent on provenance and provide two-way marketplaces for.
Mike, the talk of securitization and tokenizing assets has been around for some time. Back in 2016, people were promising this as a huge step in a value proposition for blockchain. And now it does look as if you and others are finally coming to market with these things. What has changed? How has the technology matured, or is it a regulatory shift that's allowed this to move forward?
Yeah, I don't think it's a regulatory shift. I think some of it's technology, and some of it is an evolution of mindset. So we're not the biggest fans of tokenization of securities. What we're big fans are of digital native assets that can be represented and traded on chain. I think the challenge of tokenizing something, so for example, a stock that I'm representing as a token on the blockchain to provide for immediate settlement, there's still now a trust element that stock does in fact exist, and the token is in fact reflecting that stock. And so I think as we've evolved into digital asset creation, so for example, all the loans that Figure creates are digital assets. They're all native to the blockchain, as is the equity in our cap table, as are the payments that we run on Figure Pay and the rail system. That evolution has really opened up the opportunity to deliver into the value prop of blockchain, which is trust versus truth and real-time bilateral settlement.
Mike, shifting to SoFi, your other company, you had some troubles a few years ago, some accusations of sexual misconduct and sort of a toxic work environment. And those sorts of problems are not immune to the crypto space as well. What have you learned from that experience? Are you approaching how you manage this company differently? Tell us a little bit about all of that, please.
Yeah, I mean, what we did with Figure is we really wanted to build it on a culture around teamwork. I think one of the challenges that we've had historically, is making sure that we had everyone rowing in the right direction. And I think with Figure, we've been able to do that very effectively. And I think we built over 300-person employee organization that's been very effective working together to conquer and challenge blockchain problems. So, optimistic about what we've done so far, and very happy about what we've done so far. Very optimistic about what we're doing in the future.